With credit risk, one accepts the risk of a default, and defaults typically culminate during a recession. So corporate bonds tend to be a cyclical asset class, just like equities. Historically, the best returns have been generated right after a recession when credit spreads, or the yield above a treasury bond, are wide and the economy is recovering. Today, economic conditions are more consistent with later in the cycle and credit spreads are relatively tight. Credit risk is kind of like a Jenga stack, the game Jenga. Those wooden blocks accumulate over the course of a cycle as the Federal Reserve encourages borrowing with lower interest rates. In this cycle, the credit risk Jenga stack has gotten very high. It also has many holes in it as quality has deteriorated. Measures of quality generally revolve around the debt agreements, which either favor the borrower or the lender. Still, this stack is not going to tip over on its own. It typically is pushed over by one of two forces, or both. The first force would be an economic recession, which directly influences a company's profitability and its ability to service debt. The second force relates to lending conditions. How easy is it for a company to borrow? A heavily indebted company can stay in business as long as it can keep borrowing. Once that lending spigot is shut off, it becomes more difficult to meet day-to-day spending needs. Neither of these outside forces suggest the Jenga stack is at risk in the near term. We see late cycle conditions but don't see a recession, and lending conditions remain accommodative. Generally, if a company needs to issue or roll over debt, it can be done. The last piece of the puzzle is valuation. How much additional yield is offered for accepting this default risk? Following a year of strong returns, investors are not getting much additional yield over treasuries. In a historical context, the yield spread at year-end was below 80% of historical observations. We're cautious with respect to credit risk given a picture of an overbuilt sector with high valuations and late-cycle economic conditions. In the short term, without obvious impending catalyst to trigger an increase in default activity, investors are likely to earn their yield. But given the late cycle backdrop, these conditions could change rapidly. For investors desirous of a higher level of income, we suggest a more liquid and flexible approach to this asset class.